Hey everybody, welcome back to another episode of the Hustle Harder Show. I am your host, James Gaskin, and this week we have John Curry as our special guest. John is the co-founder and CEO of Sétanta Development Capital, based out of Charlotte, North Carolina. Sétanta is a lending firm that lends to land developers, folks who are acquiring land and then developing buildable lots that they typically then sell to builders who are going to construct communities. So it's a really neat business. They do this nationwide, and that's really the only thing that they do. So John is a true expert in this space. He's been doing this for a long time, both on the equity side as well as now on the lending side. And I've had the pleasure of being able to spend quite a bit of time with John and his team over the last handful of months, and really appreciate how those guys really look at the business, the way that they think about their customers. It's very similar to the way Renovo operates, and so it's been really cool to get to know them and their team. We're really excited to be working with them. Land development lending is something that Renovo does not do, so we're able to work with those guys to help better serve our builder clients as we build our home builder lending vertical, which we're very excited about. And we touch on a little bit of that here, but really the cool part about, I think, this episode is John does a great job, I think, of giving a pretty 360-degree view of the land development process, one that I was not super familiar with going in, and I suspect a lot of the folks that listen to this show maybe aren't as familiar with. So it was a really great educational opportunity to learn about that space. Land has not always had the best reputation after the GFC, and I think John does a great job of dispelling some of the negative connotation of land and really outlining some of the opportunity that he sees looking forward. And, John's got a great story to share as well in terms of his background and the founding of Sétanta. The name is super interesting. He tells that story as well. And as you'll notice, John is from Ireland. So he brings a really interesting perspective, but a great flavor. And he's just a really all-around great guy, and really enjoyed doing this episode. So I hope you enjoy. So without further ado, please enjoy my conversation with John Curry of Sétanta. All right, well, welcome to another episode of the Hustle Harder Show. Excited to be back. This is our second episode of 2026, and really excited to be back here. And we have an amazing guest today, the incomparable John Curry, who is the co-founder and CEO of Sétanta, which is a lending firm that focuses on land acquisition and development lending. So really excited to dig into kind of the land business. Renovo obviously being really focused on kind of the rehab and construction side of real estate. I think there's a little stigma around land, and it's not a part of the business that we have been very active in, but see a tremendous amount of opportunity with. And we've really gotten to know John and his team, and really excited about what they're doing and maybe some things we can do together. So we're excited to jump in. John, maybe a little self-intro?
Certainly, and appreciate that. So yeah, as you mentioned, co-founder and CEO of Sétanta Development Capital. We are solely focused on A&D financing. We've been doing this for a number of years. My own background, as you can sort of tell from the accent, not a native. So I moved over from Ireland about 22 years ago. And I was thinking, what did America need more of? So I became a lawyer. And I was in private practice for about 10 years, and then went in-house counsel with a fund group that was doing A&D financing on the equity side. So we were investing equity in developers and private home builders around the country. This was just post-GFC, so it was broken communities in general. And we, there is where I met Rob Davenport, co-founder of the company. We were both there. We did about 1.3 billion of equity investments over that time period. And while there, realized that there was a lack of lending in the A&D space. As you mentioned, land has a bit of a stigma, as we like to joke. It's a 4-letter word. And just realized that there was a lack of lending. So moved from the equity side to the debt side, and it's been a great, it's been a roller coaster, but it has been a great experience.
That's awesome. Now, how old is the company?
So we closed our first loan, which is kind of how we joined. That's when we became a real company, is when we actually did what we were founded to do. So we closed our first loan March 30th of 2021. So we will be 5 years this spring.
That's awesome. And Sétanta is a really cool name, one I have not seen. What does Sétanta mean?
So Sétanta is an Irish folk hero. It's from a tale called the Táin, or the Cattle Raid of Cooley. So, it's about a rival clans, Queen Maeve of Connacht, and is stealing a big bull from the clan in Ulster. And it's kind of like the Iliad or the Odyssey. It is a oral tale told, goes back over 2,000 odd years. And Sétanta is the hero ultimately of it. Sétanta is his name when he's a young boy, and then does a act of heroism and becomes Cuchulainn, and that's the sort of hero, the sort of Achilles or Odysseus of the story. What's interesting about it, so it's a story that I heard as I was growing up many times. It was sort of told by a fireplace over 3 to 4 nights. And every time it was told, it would be different. It was sort of different emphasis and different stories. A lot of fun. And I was looking for an Irish name for the company. And Rob Davenport, my partner, his daughter's actually coincidentally called Maeve. And Queen Maeve is one of the main characters of the story. So I managed to convince him. I was like, let's do an Irish name. Here's the connection to you. Let's put it together. And thankfully, he humored me. And we went with it. And it's, it's an Irish name. We get called a lot of different things. It's sort of Sétanta. We get confused with the guitarist a fair amount of times. But yeah, no, we're Sétanta.
That's awesome. Yeah, John and I had dinner last night with some of our respective teams, and I learned quite a bit about the Irish language, which was super interesting, how you pronounce certain things and the silent M's and all of that. And Sétanta, the E has the accent, right? Yes. So it is pronounced like an E.
Yes. If it didn't have the accent, it would be pronounced like an A.
Yeah. So I just really wanted to make sure I was saying it right first.
Sétanta.
So you talked a little bit about what Sétanta does. I wanted to maybe kind of start with, what is obviously, like, a lot of people that listen to this show are very focused on residential investing and, probably more so familiar with the vertical component or, the rehab, fix and flip side of things. How does land lending sort of differ from the construction side of the lending business?
Yeah, it's a good question. And there's sort of multiple different ways that it is different. So the main ways we like to do loans that are maybe no smaller than 4 to 5 million. And then we've done deals up to 90, 100 million plus. But, when you're dealing with loans of that size compared to a fix or flip, so, you've got different sizes, the duration is going to be longer. It typically takes 9, sometimes up to 18 months to get land pad ready so that it can be built on. And then there's going to be a take schedule. So our average loan length is about 30 to 36 months. So again, we're in it at an earlier stage for longer. And then you're dealing with a lot more draws, on it compared to a sort of a fix and flip on it. And we're also typically we're dealing with either public builders or large private builders as the takeouts. So you're dealing with sophisticated institutions on the other side. And one of the things that Sétanta does is we only lend on projects that are 100% entitled and already have a takeout contract. So the builder takeout is already in place when we make our loan. So again, you're dealing with these large privates, large public builder, sophisticated, and you already know what your exit strategy is compared to the, fix and flip where it's a little bit more, you're still waiting to know exactly how you're going to get taken out, how you're going to get paid back.
Yeah, we're definitely in the speculative business, right? These guys are kind of doing something and they're hoping they can hit the sale price that they projected. I think it might be helpful for some people. I know it was helpful for me to kind of dig in, but like just to take one step back and sort of set the stage. So correct me if my characterization of this is incorrect, but basically you have the way it's structured is you have land developers, right, who will go out, find parcels of land, kind of thinking with the end in mind, what, looking at the zoning and the desirability of a certain market, they would put that land under contract, maybe, and you can tell me if I'm out of order here, but effectively they're going to go and find a builder that is going to ultimately purchase the lots that they're going to create from the land. And then with that, they have the land under contract, which is just raw land. And then they're going to go and do the land development aspect, which is grading it, putting in the streets and curbs and creating buildable lots that the builder will then acquire to go and build a vertical structure.
Yeah, no, that's mainly correct there. What we have, what we like to say is our ideal borrower is somebody who spends a lot of time in farmers' kitchens, who knows all of the grandkids' names of the widow, is putting the time in, is local, has done the effort that's necessary to get land under contract. It is a very grueling process. They probably have that land under contract a year, 18 months as they go through that entitlement process. In some cases, we had a project we closed in Paso Robles that was maybe 5-6 years just getting through the entitlement process. It's when it gets closer to knowing that process is in place that they actually get a builder under contract. So there is still for them a speculative aspect of it. They're doing the really hard work of identifying good land, getting it at a good price as best as possible, then working with the municipalities to get everything that's necessary to make it get the approvals that are necessary. And then when they've done all that, it's all right, I need to get a builder, convince them that they need to pay the price that gets me the margin. And then when they do all of that, now they need to find somebody who's actually going to finance it. And that's sort of where we come.
Got it. And I think this is an interesting aspect of what you do, because I think that this has changed kind of around the GFC timeframe. And please, again, correct me if I'm wrong, but, the builders, right? A lot of people might think, well, why aren't the builders doing that themselves, right? They're the ones that are going to build on it. Why would they go and pay a markup on this land that they have to have? It's, that they can't build, you've said a number of times over the last few days, you can't build a house without land underneath it. But, why wouldn't the builders be doing this on their own? Is there, what is that driver?
So what's interesting is the builders, up in, pre-GFC, the builders were developing a lot of themselves. And there was a lot more private builders. I can't remember the exact statistic, but I think pre-GFC, the public builder size of the market was about 25%. Today, it's north of 60, almost 70 odd percent. So they've grown in size. And as they've grown, they were developing themselves. And they weren't getting rewarded for it. So NVR, which is they're very, very land light. They basically, 99% of the development they do, they're buying from third-party developers. They do not own their land. They do not self-develop. Their share price has boomed since the GFC, outperformed basically every other public builder. And the reason for that is because the market, rightly or wrongly, scared of land and likes that they are land light. Starting 2018, 2019, the public builders very much pivoted towards that. They were always working with third-party developers. They were always doing some sort of land banking. Back in the day, I think I did my first land banking deal with Lisa Albanez back in the day. I think 2013, 2014, we were doing land banking back then. But it's come a long way since, where the builders are now all pivoting basically to a land light side of the business, where they're doing either land banking or working with third-party builders, and they're trying to get as much land off their books. Now, they still have, if you were to ask them, too much land that they have to self-develop, But, and this is a conversation I've had with a lot of C-level folks with the public builders, is if you were to give them the option of developing it themselves, land banking, or working with a true third-party developer, they're going to go with the third-party developer every time. And because that's true off-balance sheet, true risk mitigation, and, you know, they'll happily pay the premium that you've mentioned to, you know, to get that true off-balance sheet treatment.
Interesting. So it's not regulated. There's no regulation that prevents public home builders from self-developing. It's really just, you know, driven by the way the public markets view the risk of holding and developing land. Is that
exactly
accurate?
For the public builders? There's that, and then for the private builders, it's their lines of credit, and, you know, again, there's only so much land that their banks will allow them to have on their balance sheet. So that, you know, again, working with a third party developer just gives them that flexibility and frees up more cash for them to do what their jobs are, which is to build homes. And that's really, you know, I remember I was talking to a chairman of a large public, and, you know, he was saying to me, you know, that their whole land light position is because, you know, he's like, when times are good, we build homes. When times are bad, maybe we build fewer homes, but we're still building homes. That's our job. Developing land is not what we should be doing. You know, it really is just focusing on the sticks and bricks.
So they're kind of they look at land as an input.
Yes.
Right.
It's funny you say that, because that's, you know, as I said, we closed our first deal about 5 years ago. We had to fight tooth and nail during sort of the COVID year to, you know, convince people that land was something worth investing in and see the risk profile as we saw it. And what I was trying to explain to people is, you know, understand this space. We finance widgets. That's what we do. We finance necessary widgets for the building companies, and there is a huge widget shortage. You know, that's what we do.
Got it. No, I love that. That's a great way to frame it. You touched on this, and I think it's appropriate that we sort of circle back and dive a little deeper on land being a 4-letter word. And my brief anecdote to start us off here is, like, you know, when I got into real estate, which I've really essentially been in my entire career, but, like, it was really all kind of post GFC. I was sort of in it during the GFC, but I was in a little corner that at least it wasn't as impactful for me. But coming out of that, I remember and getting into the lending side, probably 2011, 2012, something like that. Land had a horrible reputation. It was like this major, like, the risk associated with land was really, really extreme and kind of toxic. Like, most people just did not want to touch land. It was sort of a non-starter. And I didn't really know of anybody besides the banks that were doing it. And I'm sure there were plenty of people doing it, but I just wasn't in my universe. But that was always my impression of land. And I feel like you know, until recently and working with you guys, like, I kind of had that same, you know, that had stuck. Yeah. Right. And it feels like that's stuck for a lot of people. Talk a little bit about, you know, the kind of the risk profile of land and maybe how it got this reputation and whether or not you think it's deserved.
No, it's a very good question. And I think, you know, to take a step back for a second, you know, myself and Rob both worked through the GFC. So I was representing lenders, big banks, you know, doing their REO work. They've taken back the land. We've gone through the foreclosure process, whether it's judicial or non-judicial, and, you know, had done you know, gone and saw what was necessary from a documentation structuring perspective. Rob was a hands-on developer. He was working with the dirt and, you know, was working on projects that ended up getting taken over by the banks, you know, worked for the banks on their REO properties. So we came through with the scars. We know what it takes and where things go wrong. And, you know, we're very, very adamant that we don't want to have to go through that again. So, you know, when it comes to what I'm going to say next, understand it's coming through the lens of we've seen the worst of the worst, lived through it, understand it. The key driver of what the collapse of land, in my opinion, was the government's intervention with the banks, HARP and TARP, both the Bush administration and the Obama administration. Land was seen as a toxic asset. There was an oversupply, for sure. Normal cycle, perhaps, you know, significantly more than that. But the action, in my opinion, of the governments, of the two administrations, drastically made things worse, because what was happening was they were telling these banks to get these toxic assets off their books. And by the way, the government will come in and shore up your balance sheet. So the incentive was get this land off at any cost. So suddenly they're selling land 20, 30, 40 cents on the dollar. And as I've mentioned to you over the last couple of days, I was working with a group that, had bought land at 30 cents on the dollar, ended up selling it for 60 cents on the dollar and thought we were geniuses. But the thing is, had we held on to it, had we actually finished the development on these communities, if from the bank's basis, we would have made money. And if we had actually held on to some of our positions a lot longer, we would have made 4 or 5 times our investment. So I believe that certainly some banks would have had hard times. Some land positions would have collapsed significantly. It was exasperated and distorted compared to what actually would have happened. And what it resulted in is a lack of building. Arguably somewhere between 1.5 million to 6 million homes. At Sétanta, we kind of veer more to we were 1.5 million, 2 million short. We don't think that we're as drastically undersupplied as some believe. But there was a lack of building. There was a lack of land development. We were an equity shop. We couldn't find lenders to actually give us 30, 40, 50% leverage. It just didn't exist from 2013 through 2016, 2017. It really was little there. So, there was an artificial or again, exasperated decline on on land prices. And there's people who just, that's what they remember is, and, I've been raising capital, working with a lot of different investors over the last couple of years. And one of the things we get back from is like, well, if the demand for land goes away, then it's very hard to sell. And my response is always, if the demand for any asset goes away, it's going to be hard to sell. Like land is not unique. The laws of supply and demand, still apply to us. We're not unique in that regard. So I think that there's a misremembering of what actually happened in the GFC, the role of the banks, and the fact that, if you're pricing your risk properly and you're paying attention to the supply and demand, that's, it will pay off. And one other thing to add to that is it's not rocket science. As I mentioned, supply and demand still applies to our business. 04, 05, 06, starts were up, permitting was up, inventory levels were going up, municipalities were approving projects at a higher clip than they ever had. All the signs were there. This was not a surprise. It wasn't that suddenly, that the need for a home vanished. It was that we delivered too much land. Now, we're in the inverse. We have not been supplying enough land. We've not been entitling enough land. We've not been building enough homes at a clip to make them affordable. And we're dealing with that, other extreme. So, we've gone from that GFC land is toxic to now where we don't have enough entitled land to actually attack the affordability crisis.
Yeah, it seems like there's a lack of an appreciation for some of the dynamics that led to land being a quote unquote kind of toxic asset, right? It's the government creating a forced seller scenario. And you had shared a story about, you have two developers kind of across the street from each other, one guy kind of does everything right, low leverage, can sort of, afford to sell his lots at a little bit lower price than the over levered guy across the street. But then the bank starts selling land at 10 or 20 cents on the dollar. Now, all of a sudden, the guy that did everything right by comparison, the bank, his land is overpriced now, and he's in trouble.
And I think that's one of the great distortions as well. And one of the great tragedies of what happened is there was a whole generation of developers that got wiped out.
Yep.
Who did things the right way, didn't overlever, didn't, because there's this, there's a story I tell a lot. There was a tweet back when it was still tweets and Twitter, and the prompt was describe your job poorly. And my description was, I finance the villains of children's storybooks, because it's always the greedy developer, right? Who's tearing down the community center. And I'm always like, maybe that community center wasn't the best use for that property. But it's the developers are always cast in this greedy light. And the reality is they were doing their job. They didn't do anything wrong. They got wiped out. And not only did they get wiped out, a whole generation, but, there was a younger generation behind them where they had just seen what had happened and they weren't going to get into development. So there's not only a shortage of land, but there's a shortage of land developers to actually take that risk on and do what is necessary. So you're 100% right. There's people who did everything right and got completely wiped out. Their land positions were made less valuable by the actions of the banks. And the only thing else that I'll sort of mention, I think is quite important, is the influx, and we can touch on this, the influx of private capital in this space compared to banks. And if we end up in a situation where there is oversupply in a certain market, I don't think that we're going to have the same offloading. I don't think that the private credit are going to decide to sell for 30, 40, 50 cents on the dollar. They're going to be more inclined, hopefully, if they're a good group, they're going to be incentivized to actually hold on and see it through to the next cycle.
Yeah, so there's a couple of things I want to circle back on that, but taking that last point, I know you guys, have done a really good job of hanging in there with your clients. Number one, I one of the things I love about you guys is you are very focused, and I firmly believe, and we believe at Renovo, like focus is a superpower. You guys are very focused on land. So, and you've been doing it through the GFC and have seen all these things. I think it makes you uniquely suited to be doing what you're doing and to be a great partner for clients. But I know you have some great stories about how you've supported, borrowers that, were in a challenging situation or in a situation where, the capital side of the business became problematic, but kind of going above and beyond to make sure that you can fulfill the promises you made to your developer clients. And I think that's really important. And I think that's why we get along so well, because we look at it the same way at Renovo. But I think that's worth mentioning, and you're welcome to add anything to that you want. But
well, no, again, I think from talking with Kevin as well, and understanding the Renovo story, I think that commitment to the client as opposed to the borrower, right? It's when you're at the leverage point we're at, when you're doing what we're doing, it truly is a partnership. It truly is a business, true relationship. It should not just be we're your lender, we're your borrower, and there's certain commitments and promises that get made, and it gets made on both sides, right? They promise they'll develop, on time. They promise they'll deliver the lots, in the form that's necessary for us to get paid off. But we make promises that we'll be there for them when they need it. And Sétanta, is 5 years old. I had worked with a different debt provider that I was a part of, and we were backed by a large institution. And March of 2020, we had 3 loans set to close at the end of the month. And they, just as COVID hit, I remember it, I remember it well because it was St. Patrick's Day. So it was the 17th of March.
Surprisingly, you remember it actually on St. Patrick's Day.
Well, I can assure you.
Must have been early.
It was. I definitely had some Irish whiskey to console myself after I was told by this institutional partner of ours that they just weren't going to fund these deals. And to be fair to them, that was the prevailing logic. It was, this was going to be a disaster for homes. This was going to be, just an awful time. And, we can touch, later on our mindset, of that and how that was different. But we had 3 loans that were set to close. And I, touch wood, have never issued a term sheet on a deal that we haven't closed. That, that the borrower has committed on and we haven't closed on. So, that was a very scary time. And I'm, my background in college in Ireland was I was a door-to-door salesman. I was getting people to switch their phone service from Aircom to ESAT. And I had done such a good job of doing that Aircom hired me to switch people back from ESAT to Aircom. So again, door-to-door salesman, 9 doors slamming in your face, 1 door opening, that's a good day. You also have to have very little pride. And I had little pride in this March of 2020. I called as many different investors, banks, hedge funds, insurance companies, anyone I could find who would invest and make sure that these closings happened. And it pushed into April. And again, nobody else was closing. So it wasn't as if we were really going to suffer reputational damage, but we had made this commitment that we were going to help these guys get their financing. And we worked with a fantastic group out of Texas, family office, that understood this space. Family office that also did home building, land development, and, hadn't done this type of lending before, but were interested in it. And we said to them, let's get this deal closed. We won't take a fee. We won't look to make money on it. All we ask is that you close with the borrower and you make sure that our third party vendors get paid. And, they did. They closed the 3 deals. It ended up going quite well for them. And I'm happy to say that they are now an investor with us. They're one of our best performing investors. We enjoy working with them. And if I can be as immodest to say, the reason that they invest with us, they told us, was they just appreciated our integrity to want to go above and beyond to get something closed. And that's something that I'm very proud of. I really am.
It says a lot about you as a person and the culture that you guys are building. And at the end of the day, I mean, if you're an investor, like, that's the kind of partner you should be looking for. Somebody who's going to, do whatever possible to honor your commitments. And I think that's an amazing story. So thank you for sharing. I think it would be good to, since we're here in this part of the conversation, to talk a little bit about, what has changed, right? We talked a little bit about the GFC and how land got a tough reputation. We're pretty far, relatively far removed from that today. Like, how has the land business sort of evolved since then? We touched on kind of the public's sort of not doing their own land development for the most part now. What else has changed, and what opportunities are you seeing that present?
Yeah. So again, the transfer to third-party developers has been something that has markedly changed, as we mentioned. Things have gotten considerably worse for a developer. It is harder to get land entitled. It is harder to get the public support for the density that we need to make housing affordable. And then from the land side, like, there was a time, 2018, where we talked about 2020 or 3030, and that would mean you would buy the paper lot for 20,000 and it would cost you 20,000 to develop it, or 30,000 and 30,000. One of our associates this morning just, sent around an article that the average home price in Charlotte in 2016 was 180,000. Now the average finished lot price in Charlotte is 185,000. The land price is now more than what the home price used to be, which is, who knows how sustainable it is, but it's certainly, a big shift, and shows you, where land is sort of, run up in pricing. And it's a very difficult land space. Like, we all know about NIMBYs. Have you heard of bananas?
I have not.
Bananas build absolutely nothing anywhere near anyone. and that is a growing constituency, which is like, it used to be, I don't want this to be beside me, but I want there to be housing. Now it's like, I don't even want there to be housing. It's insane. Now on the flip side, there is that buildup of demand, and it can be soft. Rates are playing a role in it. Affordability is playing a role in it, but there is still that demand, and it is pent up, and it kind of is a floor where pricing can be, because it doesn't, home prices can't fall that much, land prices can't fall that much before the need for it, is that backstop for it. So, I think the change has been the costs, the difficulty in getting it, and the scarcity.
Yeah. No, it's interesting. Housing and land, I think, as well, are both kind of notoriously sticky to the upside, right? When prices go up, even if things change, they don't come down that fast, if or that much, usually. But I was reading something in the Wall Street Journal the other day that was talking about affordability, broadly, but breaking it down into, like, of course, like, you don't want people who already own homes, you don't want to drive the value of those homes down to make homes affordable for people who don't own homes yet. Like, that's not a great solution. Rates is one aspect, but one of the, and then you have the municipalities and entitlements and some of the NIMBY things that you talked about. But but that lots have remained stubbornly high. And I think that's a really interesting thing. But, Rob was saying something yesterday that caught my attention. He was like, the people that own land, that are the sellers to these developers, these are probably farmers. That land might have been in their family for a really long time. And they recently saw, maybe even if it was a handful of years ago, they saw the land down the street sell for a certain price, and they can list off about 20 reasons why their land is worth 10% more than that. They're not going to, and they don't need to sell because they probably own that land for a long time. They're not paying on it. And it's been in the family. They actually maybe are looking for reasons not to sell. So because there's not a real need for them, unless there's some family. I mean, of course, there's exceptions to what I'm saying, but they don't need to do anything if they don't feel like they can get the price they want, and so they're just not going to discount it, right? Is that?
And that's 100% accurate. Like I'm a farmer's son, and I can tell you the farmers are the most gossipy people in the world. As you said, they know exactly how much land sold down the road for a cent, why their land is worth 10% more. That is absolutely 100% correct. And if you're not going to pay the price that they want, the only sellers you're going to find are those affected by the 3Ds: death, debt, and divorce. Whether it's, a matriarch or patriarch passing, whether it's a bank forcing them to, whether there's, a marital issue that has created this need to liquidate. Outside of that, you're paying what their anchor price is. And in certain markets, we are seeing that there is some sort of settling, but the thought process that somehow land is going to fall 20, 30, 40% because it did in the GFC, it's wishful thinking on the builder's part.
Yeah.
And it's hopeful thinking on the affordability, folks who want to make housing more affordable. Land is not going to collapse as long as we have a scarcity of both entitled land and the right kind of entitled land. Because here's the other little secret: in municipality, they're like, I don't want high density units. I would like 1 house per acre, 2 homes per acre, as opposed to 8, 10, 12, which is what we need. So it's not just that the land isn't getting entitled, but what is getting entitled for a large part is not what is needed to, actually make a meaningful dent in the shortage of homes that we have.
Yeah, I find that fascinating because I think a lot of people are like, well, yeah, we don't have enough houses, but the builders can just build, we go a little further out, we can just build a bunch of units, but it's not that simple, right? There's a lot of factors, and there's a lot of things like you're talking about with the entitlements in the municipalities creating, these overlays and restricting certain types of building. So you have like kind of all of these different aspects that kind of all combine to create this like unaffordable environment that we're in. And there's not there's not one great solution. It's a lot of little things that have to be done in concert, I think, to kind of solve that problem. And I question the will of, municipalities to really play ball, because that ends up being a little bit of a, hey, this is my self-interest, or the constituents, people who live in this neighborhood or whatever. Those folks aren't easily swayed by, hey, this is good for everybody, right? So it's a super interesting problem. You spoke to some of the challenges, and I think, entitlements is a big one. That said, I do want to kind of look at the other side of that coin, which is the opportunity. And you said something a moment ago that I thought was interesting. You mentioned like this entire generation of developers that were wiped out in the GFC, but the more interesting part was what followed that: the generation of young people who maybe were, sons and daughters of those developers, or just in that business in some form or fashion at an early stage in their career, getting kind of scared out of it. To me, when I hear that, I'm like, ooh, there's some opportunity. That means there's something really valuable, but for this extraneous reason, people aren't attacking that value.
There's a huge opportunity. Now, it takes a certain type of personality to sort of, doggedly find the opportunities that are there, but there is a huge opportunity for developers to, prove that you're good, and the public builders will encourage you and help you with that. And I would say our second largest source of business referrals are coming from public builders, where they're contacting us and saying, here is our preferred developer in this space. They need capital to grow. We want them to grow. We want them to be able to do more of our projects. Can you help them? And that's something that we're very happy to do, very proud to be able to be part of that success. But it goes to your point, which is there is a huge gap and a huge opportunity for folks to get into the development space and deliver what the builders are actively looking for.
Yeah, the land business has been really interesting for me. Like, we're people who pay attention to the show, they know, we're in a variety of these real estate mastermind groups with all these, very talented, experienced investors, just kind of across a broad spectrum of real estate. But the guys that have really been into land have been crushing it. I mean, they seem like they've been doing extremely well. And I think it's interesting. You kind of see what these guys are doing, and they are long cycles, right? These deals take a while to put together. There's a lot of, but what's really neat about this, and you touched on it a minute ago, but for folks who don't know, the builders, and whether they're public or private or regional builders, will give you a contract, right, on these lots before you break ground, and then they'll provide a deposit it's typically non-refundable, correct?
Yep, well, it's
probably there's ways they can get out of it if they really want to.
They don't like this particularly. So if they're listening, they can cover their ears or shake their heads. But from our perspective as the lender, we will not have to, as long as we're financing and helping with the project, we won't have to give the deposit back. They can't look to the land to get it back. They can look to the borrower. They can go after the borrower and say
if they don't perform.
If there's a default under the contract, but if there's a default under the contract, the agreements we have with the builders is that they can't get their deposit back. But what in return for that, we also agree that if we develop the land, that we will sell it to them subject to that deposit. So
Got it.
They know that they're going to get that, and we've got that trust with the builders that we understand the space and we will perform.
Yeah, and then for the developer, they're kind of in a really great situation because you pointed it out earlier, but in our primary business, our borrowers are making speculative bets. They don't have that takeout set up and at an agreed upon price going in. Like, that's variability to that and market driven. Land developers will have a lot more certainty theoretically because they've got a builder who said, yes, I like this project. If it goes to plan and, the lots look like this, I will buy them on a pre-agreed, that's what the take schedule is. So the developer is going to deliver X number of lots on some time frame, and the builder is going to buy them at a price. So a lot of the mystery is a lot of the volatility is taken out. What that's going to be. And that is kind of what allows you to go and get financing from someone like Sétanta, is that now we have a lot of the knowns figured out. Now it's just execution, right? Execution risk is kind of where you're focused.
Exactly. And, we touched on it before. My partner, she is very risk averse. And, as I was forming this business, she was, as I like to say, she covered our overhead, as we were starting this. And I was, shortly unemployed as I was gathering up the investors to work on this. And, I said, she's risk averse, and I had to walk her through, this is how the risk, actually plays out. Here's how we've de-risked it as much as possible. And it's kind of like, once I got her on board, I knew I was going to get investors on board. I was like, all right, if I can convince her that this is a low risk or lower risk compared to the return opportunity, that would be the case. And to your point, the developers are taking a position where they have a takeout, they have it priced, they should have their bids and know what it's going to cost them. And then with us as their financing partner, they understand that they can, execute on multiple projects. And that's one of the things that we're proud about, because we, unlike some in this space, we have multiple sources of capital, multiple buckets. Capital allows us to structure deals in a way that works best for the developer, but it also means that we can do 5, 6, in some cases we've done over 8 deals with one group. So we're able to sort of, be a long-term committed partner to somebody. But on top of that, we're able to give them sort of that higher leverage, because we will give them credit for that builder's deposits. And then we require them to bring 3 to 5% of the total cost as their own equity. So we'll go up to 80, 85% LTC as necessary. And that allows them, to the point of what the builders are looking for, they can stretch their equity and do multiple projects, knowing that they, as you pointed out, have that takeout there. And with us as their financing partner, they've de-risked the capital, they've de-risked the takeout, and now all they need to do is execute.
Yeah, no, sounds like a pretty great business to me. You said something there. At lunch, you and I were talking about this a little bit, but I think the comments you just made, the banks, right? Historically, banks have been big in this space, and I'm sure, they still are. Like, talk a little bit about how the banks play in this world, and maybe some of the differences between kind of what you're doing as a private lender as opposed to what some of the banks are doing, and how that might impact the customer.
So as we touched on at lunch, the National Association of Home Builders, in 2005, estimated that 90% of all financing was done through regular banks. They were doing 80, the lesser of 85% loan to value based on forward-based contracts, or 100% loan to cost, which basically meant 100% loan to cost. So you're like, how did we get oversupplied? Well,
yeah.
And it was prime plus a half. Initially prime plus a point, and then it ended up going as low as prime plus a half point. So that's, where we were. They, as I mentioned, were very reluctant to get back into the land space. Started to re-enter 2018, 2019. And then I think in the post, rate increase world, with some of the commercial real estate balance sheet issues that have, plagued groups and had banks like Signature Bank, go away, and other banks under a lot of pressure, there just isn't the desire to really lend into the space. And if they do lend, they have a lot of criteria. They want more equity from the borrower. They typically want their deposits to be with them. They are limited to how many projects they can actually do. So they're not really as attractive as they once were. Coupled with that is there's been a rush of private credit that's come into this space that, is now providing that higher leverage point, and is, being that alternative to the banks. And what's interesting, you and I are going to be in Vegas next week, for a conference, and I'm speaking on a panel about financing, land. There's not one bank on that panel. It's all private credits. So they have really retreated, and they're doing warehouse lines. They're lending to the lenders, but they're really not. In our experience, at least what we're seeing, they're not really a solution for a developer, specifically a developer that wants to do multiple projects.
Yeah, I think that's really, really interesting. So they're participating in the space tangentially by lending to lenders, but they're not as directly involved. And what you're saying does make sense. I mean, I know some of it was pretty reactionary, right? Silicon Valley Bank, Signature Bank, had some pretty tough real estate stuff on their books, and specifically, I think, multifamily. And they kind of like maybe overreacted by really shedding a lot of real estate risk in general. Maybe that's regulator driven, but it is a good thing that banks, unlike, I think it's important to make the distinction, like, unlike what we're doing, we're raising capital from institutions, Wall Street, asset managers, and that's great. Banks are the stewards of our paychecks, right? So we do want them to be pretty risk averse, but that is the way the banks operate. And so, it just seems like kind of there's this perfect storm where, banks traditionally being very involved, kind of, really trimming back their involvement. And then you also have the just tremendous inflows of capital from, institutions and Wall Street, international insurance companies, et cetera. So you kind of have this nice Like that's coming in at a perfect time to sort of fill the gap. And yet you still don't see that many, I think land specific lending businesses. Like you guys, I mean, I think are there's not a ton of you out here that I'm aware of. Am I wrong on that?
No, there's a lot of capital that has come into the space, but there's not a lot. It's still a niche enough area. It's still small enough that the good lenders there, we don't trip over each other that much. We're not really competing for the same deals as much as as much as you guys see, and where there's 5 or 6 groups, if not more, all looking at the one thing. We're
more every day.
Yeah, exactly. What's interesting is the the there is new competitors, I would say, and I'm certainly biased here, but I'd say you can count on one hand the number of groups who are similar to us, and the fact that from an integrity perspective, but also from an experience perspective, have gone through the ups and downs of it. And we were touching on this at lunch, but with all this capital that's come into the space, given how land was seen as toxic, I think a lot of folks have somewhat reluctantly come in because they just couldn't avoid it anymore.
Yeah,
they couldn't pretend that it was not an asset class worth investing in. But this is a cyclical business, and there's going to be ebbs and flows. One of the biggest problems I see with our industry as a whole is we are a 3 to 5 to 7 year business for a community to get developed. And we're being dictated by builders who are on a quarter to quarter basis. So they overreact, they push too hard, they pull back too hard. And I'm curious, again, I'm biased, but I'm curious that when we do hit a bump, and we're going to hit a bump, which lenders are able to see that out and be a good partner, and some are reactionary and end up either defaulting, foreclosing, looking to offload. But given our experience of working through the GFC, we're in it for the long haul.
Yeah, and diversification is important, right? But at the same time, I think especially in this space, having a firm like yours be exclusively focused on this area is really great. And if I were a developer, I think I would put weight to that, because I agree with you. I think there are people that are in it because it's an opportunity, seems like an opportunity today, or they couldn't get away from it. But it maybe is treated a little bit more like a trade. Like, hey, there's a window here.
Mm-hmm.
We have the capital, like let's jump in. But when things get rocky, those are the firms that hop right back out.
Exactly.
Right. And I think if you're a developer and you're in this business and you've built something that you want to continue to scale, I think you want to partner with people that have a commitment to the space. And you guys certainly have a commitment to the space.
We're, myself and Rob, we call ourselves dinosaurs because we require everyone to be in the office, but not only are we dinosaurs, we're old dogs. We're not looking to learn new tricks. We know A&D. We like it. We've come through it. We like to say that we're developers who lend. We're not lenders who are trying to understand development. We've got the scars. We say this, and it is sadly true. There is no problem that our borrower will encounter that we haven't personally encountered ourselves.
Yeah.
Whether it's hitting rock, dealing with long-term, municipality delays, whether it's, just having, bad subs or needing to deal with weather delays or weather erosions. We've seen it. We understand it. And, one of the things we say to our borrowers all the time is when we get that pro forma, we only know 2 things for sure. That first lot take will not occur on the date they say it will, and the numbers are wrong. We don't know which direction they're wrong. Typically they're under, but we know that those numbers are wrong. And, we don't, people have heard me say this multiple times, but builders and developers are the 2 most optimistic people you will meet. They have to be to get up in the morning and do what they do and deal with the municipalities, deal with all the delays. They have to have that. We try not to take advantage of it. If they ask for a 2-year loan, we give them a 3-year loan. They say the first lot take will be in June. We smile politely. We push it out to December. We're like, we don't want there to be tripwires because we know it's not going to go to schedule. There's going to be problems. It's that Donald Rumsfeld quote of known unknowns and unknown unknowns. Like, that's land development. We know that's going to be the case.
Yeah.
So let's not take advantage of the optimism. Let's be good partners. And I know that's something that you guys at Renovo, have a very similar attitude. And it's one of the things that we like, of listening, to you guys and seeing what you're doing, is that we're very much aligned in a mindset.
Absolutely. And I think that focus and not just lip service to being a good partner, but actually showing up and doing this for a lot of years now, I think is really, really important. And it is absolutely, I think, the reason that, we get along and we're sitting here today. Myself and some of the other Renovo team have been in town for a day or two, sitting down with you guys. And I thought it would be, nice to just kind of touch on some of the things we may be looking to do together. We're kind of, we've got a strategic partnership that has kind of developed between the two firms. And, I think it's a really exciting one. It's something we're super pumped about. Let's just touch on that briefly. And it's very early days and there's a lot of work for us to do. But, we see a tremendous overlap in terms of the value system, the integrity, really wanting to partner with your clients and showing up and actually living that, I think is super important. The fact that you guys really, really understand your space and are very committed to it, I think is super important. And what you guys do is incredibly complementary to what we do and vice versa. And I think it would be crazy not to try to find ways to work together. We certainly run into opportunities all the time where someone, there's a land component and, it's just something in the past we've said, it's not what we do. But, to have a strategic partner like you guys to be able to kind of, satisfy all aspects of the deal and make a customer really, really happy with kind of a cohesive sort of focus on that service and delivering for the client, I think is really, really exciting. So I don't know if there's anything you want to touch on there, but
yeah, no, certainly. I think, you've hit, all the high points. Similarly, we come across folks looking, certainly our private builder clients who are looking for that vertical financing, looking for a variety of reasons, alternatives to their existing building lines. And whether that's for immediate needs or whether that's, part of their, whether for sale or for rent sort of strategies. So again, to have a strategic relationship is quite exciting. I think it works for, we see this very much as a two-way street. And what's interesting is, I've been listening to a number of your podcasts and, Kevin.
You're the one? No.
Yeah. You listening to Kevin, you've mentioned before, having that goal of being the biggest. But I think the other part of it is, and that's something that we share, we would love to be, one of the biggest groups in our space. But more importantly, we want to be the best. We want to be that best partner. And that's a quality and a goal that we know we share from talking with Kevin. And then the other thing that's interesting is we share a relationship. We both have worked with the folks at Victory Park. I know they were an initial investor with Renovo. They have been a great partner of ours, and we've sort of grown with their assistance. And I know that they helped facilitate the introduction with Kevin. And there's three partners in Sétanta, myself, Rob, and Tom Stoltz. And I know that Kevin first connected with Tom through BPC. So we're again, I think that also shares the a common DNA of sorts between the two companies.
Absolutely, yeah. Thank you for bringing that up. We did get introduced through Victory Park, and those guys are fantastic, and we have a tremendous amount of respect for them. And when they say, hey, we know some guys that we think have a very similar sort of approach and in a complementary thing, that's just something we pay very close attention to. So very, very happy that we were able to get connected, and really excited about a lot of the synergy. And I mean, as we said earlier, right, the land piece is kind of a necessary aspect of everything that follows, right? It's the very beginning of the process. And so if we can kind of marry both, our vertical, sort of kind of more towards the end of the process stuff with what you guys are doing, there's no doubt, that there's a lot of opportunity, and especially if we're kind of all singing from the same sheet, if you will. So super exciting. Really has been amazing to be here in Charlotte. We're in Charlotte today, and spending time with you and your team. It was great to get to know your team. A lot of Irishmen.
There are. We're, it's, the diversity push that we the first diversity push we had, that Rob was like, we have our quota of Irish people. We have, I think, just 4 of us in the company, and they've been great. Mark Nisi was one of our very first hires, and from Galway, and since then we've added Joe and Donald to the team as well. So we're we certainly have an accent, and not just above the E.
Yeah, Donald with a silent M.
Yes,
I learned that last night. Very proud of it. No, listen, it really has been fantastic. It's been great to spend time with you. I remember when I was, prior to joining Renovo, Kevin invited myself and some other members of the team that I was on previous to come to Chicago and do something very similar, talk about the business and how everybody's doing things, and maybe ways that we could. And I think that's super powerful, and it's been amazing. So you guys have been great hosts. We enjoyed some awesome North Carolina barbecue last night, and I'm still full. But it was really great, and I really appreciate you sitting down and taking some time for the show. I think people will get a lot out of this, because I think it's a very misunderstood or understood, if you will. That's not a word, but what I'm going for. Aspect of real estate that I think is really important. Any final thoughts?
No, again, I appreciate the time, appreciate the hospitality. Again, we spent some time in Chicago, and we had some deep dish pizza, so we felt that we would return the favor. And I think we're excited about what we can do going forward. So thank you very much for having me on.
Absolutely. Well, thank you, everybody. We'll cut it off there, but we'll be back shortly with lots of great content, and look forward to bringing you more. And John, thank you again for your time.
No worries. Appreciate it.
Cheers.